explosions in retail F&O trading and said that exchanges must protect household savings from future challenges. Now, Nirmala Sitharaman appealed to decision makers at NSE and BSE to work closely with markets regulator SEBI to create stringent regulatory standards. Any unchecked explosion in retail trading of futures and options, she warned, could create future challenges not just for markets but for investor sentiment and household finances. Sitharaman was speaking at the Vision for Indian Finance Markets event at BSE in Mumbai. Finance Minister also spoke about the active role that household finances and participation of the middle class investor has been playing in protecting market from fluctuations in the past. Hence, she said that there is a need to protect investors and their contributions. Listen in.
Any unchecked explosion in retail trading of futures and options can create future challenges, not just for the markets, for the investor sentiment, and also for household finances. Household finances have made a generational shift, which I just explained. We want to safeguard that. We want to ensure that that's not going to be shattered.
Welcome back. Now, the RBI Governor, Shaktikanta Das, has raised concerns on the increasing gap between credit and deposit growth. Speaking at a Financial Express event, Governor highlighted that household savings are moving away from traditional deposits to mutual funds and other instruments. He warned that slowing deposit growth can create structural liquidity issues. Take a look.
Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries.
Of the markets, the real power that lies in the hands of the investor is if they take a longer term view on their investments. So short-term trading has its own place. Of course, many of you would have read SEBI's research report, which talks about how in the F&O segment, unfortunately, 90% of all individual investors lose money.
However, at an individual level, what we have expressed is that at an individual level, investors are losing money. And therefore, it is from the investor interest point of view that we are wondering as to why they are continuing to do this trading when they keep losing money, and that when it is very evident that they will keep losing money.
Hello everyone, welcome to Blue Dragon Universe. This is the Blue Dragon Actuarial YouTube channel. So our today's topic is, you have already seen that portion of the video where many people who are the regulators, the top guys in regulators or top ladies in regulators, they are saying that there is a lower banking deposit may lead to systemic risk, right? And we are going to examine that topic in detail to understand how, the basic economy of a country operates and whether what they are flagging is actually correct or not, whether they are showing the real picture or they're not showing the real picture. And we are going to close this video with another, slice of the video of a regulatory chairperson. Right now, in this video, we are not going to talk about any allegations or anything else that is against any particular chairperson of any particular, regulation that is outside the kind of the bound of this video. And we are going to just cover the pure, economical standpoint of what they are saying. Kind of move into the concept. So, how banking system work? Now, this is an example. Suppose a customer deposit 1,000 rupees in bank A, right? Then then there is something called reserve ratio, and we'll see what this reserve ratio is. So what bank will do is bank will keep 100, and that will be called reserve for the bank, right? That is going to help the bank in dealing with uncertainties and other risks. Like we keep reserve in life insurance, bank also keep reserve, right? And if in fact the life insurance regulation like Solvency 2 or IFRS 17, these are based on banking regulation, which is Basel 1, Basel 2, Basel 3. Banks first brought this regulation, and then it was copied in different manner with some, we cannot say it is copied, but you can say that it is inspired by the banking regulation or Basel regulation. The Basel regulation are the kind of the forefront of the regulations for the maybe the entire the finance industry, right? So bank A will keep 100 with them and they will loan out 900. So then the borrower who has borrowed this 900, right? So that borrower will, kind of deposit this in bank B, which is its own bank, right? Maybe the borrower would be a, corporate, right? So that corporate will have a different bank account in form of a current account, and that will be get deposited in bank B in this case, right? So obviously because the bank has a reserve ratio of 10%, so out of this, bank B will keep 90 as a reserve and will loan out 810, which can be taken by any other person as well, and the cycle in this way repeats, right? So that is how the economy functions, right? And that is why we call central banking system, right? Because the banks are kind of related to each other. You keep the money in one bank, then that bank loans out the money and keeps something for reserve, and the other bank kind of loans something, right? And this ratio, the reserve ratio, is kind of determined by the central bank. In this case, in our case, it is RBI who is determining this ratio, right? Because as I was kind of saying that this process gets repeated, right? And each bank kind of keeps 10%, which is the reserve ratio, and loans out the 90%, right? So in this way, money gets multiplied. This is called fractional banking system. If you have studied SS7, if you are going to study SS7, or if you have studied macroeconomics in the past, in the graduation, then probably you are already aware of this, right? This is called fractional banking system. The main purpose of fractional banking system is to multiply money. That is why the concept of core banking comes into picture, where every bank is kind of related to each other, right? One bank, if one bank falters, then the entire system falters, right? So that is also the weakness of fractional banking system. But otherwise, it is used for multiplication of money, which you can see here. So this is the ratio, which is 0.10, and 1 by 0.10 is 10. So basically the banking system multiplies the money, which is the initial deposit of 1,000. It gets multiplied to 10,000. So usually it will be the central bank will print money, and then that money would be given to a particular bank, and people can take loan from that bank, and in that way the money gets multiplied. So central bank eventually controls the money flow in the system, right? So that's why central bank RBI is a independent. It's supposed to be an independent body. Whether it is actually independent or not, it's a matter of contention, and it depends on the government, right? But that's how central bank is supposed to be, right? And this is in pictorially you can see this. This is how a fractional banking system works. So this is this is the maybe the central bank, and it gives certain deposit to other bank, and then they loans out, and then again they loans out, right? And they also keep some reserve, right? And then the money gets multiplied, right? So this is how the money gets, money is circulating, right? So in that way, and then also the bank has to keep deposit with the central bank as well, right? So there are all those things, reserve repo ratio and CRR, etc. All those things comes into picture. I'm not going to go into details of that, but you can understand that money is flowing in that manner, and money is getting multiplied in that manner, right? So the banks are also keeping reserve, but banks are also lending most of the money for or giving out most of the money for lending purpose, and this is how fractional banking system works. It also means that if one of the bank fails, then like if this bank fails, the entire banking system will get impacted, which happened in SBB bank collapse. So I've already made a video on SBB bank collapse. You can see that. You can search in the YouTube channel for SBB bank collapse, right? And you can search and you can check that video, right? So in that case, one of the bank, one of the bank was not able to meet the liquidity crisis. They collapsed, and because of that, we the entire banking system kind of passed through a difficult time. And we have already, like US banking system, at that point of time when SB Bank was collapsing, many people flagged it as a systemic risk, right? But it did not turn out to be, because it was handled well. But there are many companies like Credit Suisse, right, who are selling credit default swap. They also got captured in that process, and they also had to sell the stake, and they were acquired by other companies or other banks, right? And the central bank also bailed out a couple of entities in that case, right? And it also led to failure of some entities as well. So whether they should be bailing out, whether they should be let entities function, right? That or they should let the entity go bust, that depends on, once again, the government and also the philosophies of the central bank. So that's how it is, right? There are multiple, points against it and in favor of it. But once again, for our purpose today, we need not go into details of that. We need to understand how the economy works. The economy works to fractional banking system. Central bank creates money and then it goes to the bank, then they loans it out, right, and keep a portion of the reserve. This portion of the reserve that they keep is controlled by the central bank, and that is how money is multiplied in the system, right? So where do bank keep their money? That is the most important question, right? So the bank keep their money mostly in overnight deposit because they are in a short-term business, right? So because you might any day you might, you decided to say you are a very rich person, you have 10 crore in your bank account and decided to remove that entire 10 crore from that bank, right? So the bank also need to kind of liquidate their investment, right? So mostly they deal with short-term risk, right? And that's why they whenever the bank has excess money, they would like to lend to other banks. Whenever the bank has lower money, they would take deposit from other banks, right? Or they would loan from the other banks, and that is kind of captured in the money market, right? So the bank mostly have their deposits or investment in the money market, and money market probably something which is of short term duration, right? 90 days, 60 days, 1 month, right? Max 180 days, in that way, right? So that is what we call money market instruments. Now remaining portion is also kept in capital market, which is for, like, suppose a bank is working on long term basis, might be it has some accumulate some corpus of money, then some portion would be free, right? And that portion of the capital can be invested in stock, good quality stocks. It can also invest in corporate bonds, government bonds, right? So it will be invested in capital market. Usually when we talk about markets, we only mean stock market, but there is also bond market, which is mainly used by institutional players. That is why we do not say or mention mostly about the bond market, but you yourself can invest in bonds and stocks, right? And here we are going to kind of understand in one of the slide, we are going to understand how you can also make use of the bond market. I personally make use of the bond market, right? So that is how you can pledge your securities and you can get money return. So remaining portion is kept in capital market, right? So this is how bank functions. You can see all your money, right? All your money is actually flowing into the market, either through either into the money market or into the capital market, right? So banks will have problem, like I mentioned in the case of SVB, if there is a liquidity crunch, and they are forced to kind of liquidate their investment at loss, because you are taking out so much money from the bank that bank thought that that this amount of money will not be kind of removed from their investment in one go, and you are forcing the bank to give you money. So in that case, they have to liquidate their investment, and if those investment are in loss, then they would realize that loss, and they can, then there is a risk that they can go bankrupt, right? Or it is called bank run, because banks cannot go bankrupt, so it is called bank run in their case, right? So if one bank fails because of this, this core banking nature, because of this, inherent flow of money, right? So the fractional banking system will trigger issues in other banks as well. And this is the risk that they are pointing out, that there can be a systemic risk, right? So this is the risk. Like if one bank falls, then there can be other risk. Other banks would also be at risk, right? This is the risk they keep on pointing out, that there is a systemic risk, which is the fractional banking system, because the way it is designed, if one bank faces difficulty, especially if it is a large bank, if ICICI Bank felt difficulty, or if HDFC Bank, kind of face difficulty, then SBI will automatically feel difficulty, right? Because they are also lending to each other, and they are also interacting with each other, right? So if one bank, one big bank, kind of uh, faces difficulty, then it will be the system that will face the difficulty, or system that will face the risk, and that is what is called systemic risk, which is what happened in 2008 crisis, right? AIG was a classic case, how it kind of entered into trouble because of this kind of systemic risk, right? So where do mutual fund and brokers keep their money? Now we know that banks keep their money in money market and capital market. These are the only places bank can keep their money, right? So bank is also investing so that bank can earn return, right? So that they can give you the return, right? So where do mutual funds and broker keep their money, right? Now this is where the interesting thing begins. Most big mutual funds are subsidiaries of banks, right? And brokers also, mostly they are subsidiaries of banks only. But these days there are other brokers like Zero, the primary example of brokers in India, who are not funded by any banks or who are not subsidiaries of bank. But the money with mutual fund and brokers are kept in banks in their current accounts. Like if you have deposited a large amount in brokers or mutual fund, you will also get a current bank account number where you can transfer the money, because there is UPI limit of 1 lakh or 2 lakh usually. So you cannot transfer money beyond that. But if you want to transfer money beyond that, then there is way. You can maybe transfer the money using the current account, right? In brokers, you can easily do that, right? So, and these days in brokers, you can also purchase the mutual fund. I'm not talking about ETFs; they are already there, but other methods are also there, right? So other mutual funds are also there. So the basis of this discussion is you can actually invest in mutual fund. The brokers one, they were kind of flagging out that companies or people are actually moving away from traditional banking like fixed deposit and anything, and they're putting the money in mutual funds or brokers. Means that the brokers or mutual fund again keep the money on the banks of the current account, right? So their entire reasoning is baseless, because the banks are the ultimate keeper of money, and banks do not have any regulation defined over them, right? So banks, there are, for mutual funds and brokers, there are regulation for usage of this money. If you do not know, there is a broker called Curvy, which do not exist now, but the client's money, they use the client's money to trade on their own, and they use the client money as their own money, and then they made losses, and there is still court cases going on. There are many people who have not recovered their money, right? And based on that, SEBI has created called Investor Protection Fund, which I have never seen them use that, right? But they're supposed to actually pay the money to the Curvy retail clients, but they have not done that. And there is still court cases going on. There is still, people have the owners of Curvy broker have fled the country, and many people have lost money, right? So from that point of time, the SEBI has kind of created multiple regulation that you cannot, the broker has to return free money to you. And if you have not traded for a certain month, the broker has to return the money. You will always get some statements regarding what is your money that is kept with the broker. So these are always, this there a regulation over that, but there is no regulation over the banks. Of course, I mean, banks need to invest on, they need to manage the risk, right? But there is no regulation that after certain time bank need to kind of somehow return the money to you. That is not there. That thing only happened with brokers because there was a scam, the Karvi broker scam. You can once again Google about that. So the point of the summary or the moral of the story is mutual fund and brokers keep their money with banks only. And by default, banks will invest in capital market and money market. So eventually every penny of your hard-earned money goes into the market. So when your mom and dad say, hey, do not spend money on stock market, it is gambling, or like how the finance minister was saying, that is because of the lack of knowledge. They do not know the circle of money, and because of that lack of knowledge, they believe that the money is not going into the stock market, or the money is not going into the capital market. The money is staying with the bank. The bank also put the money into the market, right? So it is complete lack of knowledge, unfortunately, from people at senior level who is making this sort of statements, right? And that is where we can say the mutual fund brokers also trade in capital market as DIIs, proprietary trading firms, right? They can also do their own trading, right? So ultimately, every penny of your money goes into the market, be it capital market, be it money market, right? But it goes into the market. Nothing stays with the bank, right? And banks are the ultimate keepers of money, because even the money of mutual fund brokers, that also flows into the market, but through the banks. They cannot directly invest. They keep the money, and they would also have their own trading account and everything else, and they keep the money in their current account, and using that, they kind of also put the money in the market, right? So the money flows into the market through the banks for everyone, for each one of us, whether you are an institutional player, whether you are a retail person. Money flows into the banks, money flows into the market through the banks, right? But the ultimate destination of every penny is market, right? With capital market or money market. That is the point you should remember from this, right? So who is the ultimate keeper of money? I've already mentioned it's banks, right? And banks receive deposit for DIIs, retailers, and even FIIs, right? If FII want to trade in the Indian market, which they are not saying, but we'll see in the later portion of this presentation. So they also have to keep the money with an Indian bank. Then they can also take the money outside India, right? But there is also rules and regulation for that as well, right? And they invest this money as per the Basel norms and industry practice. Who invest this money? The banks, right? Banks invest this money. Banks are mostly exposed to short-term risk and has they invest in money markets, which we have already discussed. So, as per you now, who is the most powerful regulator based on this, kind of whatever we have discussed and whatever you have, kind of heard, because almost everyone has kind of mentioned about this. RBI is the central bank governor, SEBI is the security market, right? IRDA is the insurance regulator, PFRD is the pension regulator development authority. These are the four prominent regulators, right? All of them, as I mentioned, all of their money goes into the market. So who is the most powerful regulator, right? If you ask this question, I think your answer should be obvious. The most powerful regulator is SEBI, right? Because they are making all the decisions because every penny, as I mentioned, is lying in the market. So if someone is saying be it finance minister, be it the the chairperson, be of SEBI, or be it the maybe the the governor of RBI, if they are saying that there is a risk because deposits are moving away from the bank and they are flowing into other avenues, right? If that is the risk they are flagging, then it has always been the case. Then that is not a risk at all, right? So once again, lack of knowledge or maybe increase in paper knowledge does not help, even though if you are in a senior position, right? Moving on, because eventually all money enters into the market or capital market, which we have already discussed. So it is incorrect to say that banks are losing deposit to stock market, right? You cannot say that because that is the very nature of the economy. Banks are supposed to keep their deposit in the markets, right? So what is really happening, that is Gen Z, which is the the current generation who have just entered the job market. They are not smart financially. I am not saying that. The research is saying that, right? Research, you can once again you can Google about that. So they are not very smart financially, right? So they are showing up by spending money in luxuries, moving, going to a Maldives trip, or and spending money. They are putting that in Instagram, social media, because this is the generation of social media, right? So showing off in the social media like others do, so that they can also live up to their peers and they can also say that hey, they have a good lifestyle. All this makes them spend money, and because they are spending money, the money is not with the bank. The money is not following the usual cycle because now it is being spent in luxuries. You are spending 4 crore to buy a Porsche or whatever it is called car, right? Or a Ferrari. And then that money, you ideally, in our generation or in the previous generation, the generation before, that money should be lying in a fixed deposit. But because people are spending in luxuries, that money is not in the fixed deposit, right? So what the governor of RBI or what the finance minister usually actually wants to say is people are spending money in luxuries, and the government of India, because they right now at this point of time they do not have much funds, so they cannot afford that. They need the fund from the banks. They directly need the access to the fund from the banks so that they can do various stuff, right? But because of the maybe incorrect financial planning or economic planning, they were not able to do that, and now this is the last resource they have. So they need the money from the bank so that they can do their own activities, right? They can pay the government employees and whatever, they can keep the nation running, right? So the problem is not that the people has moved from the bank to the stock market, right? Because eventually money is coming to the banks only. The problem is that people have not moved to the stock market. They're spending money unnecessarily, right? In the luxuries. Also, money is flowing outside India, then also that is a problem, right? If you are spending money in luxuries, it's a problem. If your money is flowing outside India, then also it's a problem. Now, many people have left India. You already know that there is a research report published over that, and people who are seeing this video, I can say 95% of them would leave India if they are given the opportunity to do so, right? So, money is flowing outside India in that in some manner, right? And thus money is not with the Indian banks but spent, right? And that is the problem. money is not with the Indian banks, but spent. Money is not in the stock market, because if it is in the stock market, then eventually it will reach the Indian banks. But money is not with the Indian banks or in the stock market, is spent. And that is the problem which the government is not highlighting, right? Now, what is really happening again? So banks have increasing number of bad debts, right? So bank has not done their due diligence. They have given increasing number of bad loans. Now they're struggling to recover. How can they make those make good of those there, or maybe make good of those the inefficiencies that they have? They can do so by increasing the deposit, so that that will kind of capture their inefficiencies, or let go of their inefficiencies, and that is why they require the bank deposit. So they cannot say the correct thing, because the moment they start saying the truth, that we have a lot of bad debts, we are not doing well, and that is why we need deposits. The moment they start saying so, it will create a question mark on the government. The government do not want question mark to be raised on them, right? So that is why the government is creating a false narrative, which as per me is very shameful of the government to do so. Moving on. So government is taxing to GST. You can see that recently the GST Council is kind of is going to increase or introduce GST for UPI transaction below 2000 or up to 2000, right? So there is a lot of been debate over going on over that. So I believe that you have already heard about that, right? So government is worried about foreign HFT firms making money in the FNO trading, like they have mentioned. And also after this video, you can also kind of will I'll put a small clip where the SEBI chairman is kind of saying something on similar lines. So government is not worried about the losses of the retailers in FNO. They are worried about the money flowing outside the bank, right? And who are making money? The HFT firms are making money. HFT means high frequency trading. I have already mentioned about that in my previous video, which is the quantitative finance video, like what HFT firms does, right? I have already mentioned about that. So you can check that video. And finally, the government is, like I mentioned, shamefully hiding the real picture, trying to appear as a messiah, right? So that they also get more votes, right? But that is actually not the real picture. So challenging traditions, right? So challenging tradition is government or regulator, right? They have to increase awareness and education, but not to interfere in the lives of the common people. You cannot say people that you should not put money in the stock market or capital market. It is their, maybe it is their wish. They can put money everywhere. And also, like I mentioned, you can also purchase bond, you can also purchase stock, and you can place that with your broker, and that will release some margin or some capital with some haircut. As for example, suppose you have 1 lakh that you have invested in bonds and stock, you can place that with the broker, right? So the broker will release 80,000, will that there will be deduction of 20% as haircut. And that 80%, 80,000 can be used for FNO trading, for option and future option trading, right? So if you are, and in that case, if you are a good FNO trader, which is the approach that I use personally, and if you are a good FNO trader, obviously your bonds will increase, or your investment will increase in value, and it also make trading profits. So it is completely incorrect to say that you should not be putting your money in the market, or you should not be doing FNO trading. What you should do as government or regulator, you should spread awareness that this is a risky thing. You may lose money, but where the common people wants to keep their money, it's none of government's prerogative. It should not be government prerogative. But once again, that depends on the type of the government, right? So trading in FNO is, once again, they were saying that it was gambling, 90% people loses, but data of past is a bad indicator of future, right? And there are many professions where I think only 10% is the success rate. Even in actuary, 10% probably would become successful, right? And even with more papers, because I believe that there would be a time when papers would not be mattering anymore, especially in India. So that is the case, right? And even government jobs, IAS, IPS, all those exams, only 10% are successful. But past data is not a good indication of future. Once again, all those people who are making comments and making careless comment, and also the developed countries, all developed countries, if you see, They have huge derivative markets, right? And it's foolish to run away from the same, because India is going to be a developed country. At least that's what every government claims, not only this government. And profit and loss in FNO is defined as business, right? And profit and loss can also be defined like you can enter into strategy where you know that this is the maximum amount you can lose, this is the maximum amount you can gain, right? And that is where it cannot be called a speculation. So many people say that derivatives are created for hedges or hedging purposes. And that is true. It was created for hedging purposes, but since then there have been so many changes in regulation. Now there is central clearing party, and there is European option, American option, and there are so many things, so many changes, right? So it is whatever has been created maybe 200 years back, that is not relevant today. And if you still think that FNO is speculation, like if you trade, something, if you trade only in FNO without any hedging purpose, then that is speculation. Then that is only the thought process of the few people who are in the Indian regulation industry. Because in the rest of the world, FNO income is treated as a business income. It is not treated as a speculation at all, right? And you can check the regulation for the rest of the world. And like I said, it is my money. I can even burn it, right? So the government can't dictate where I want to put my money unless it is an autocracy or unless it is an emergency. In those situations, government can dictate, right? But otherwise, in a democracy, government can dictate, which the government is trying to dictate by giving you false reason, right? So that is not as we have kind of seen that is not the reason. And obviously, you can regulate the bank for bad loans, ban FIIs if you do not want the money to go outside India, right? But why are you putting restrictions on the common people of India? There is no such reason for you to put any restrictions on the common people of India, right? So that's it. I hope you were able to understand what is going on here. And of course, you are welcome to write your comment and suggestion. And yeah, and I'll see you in future videos. But do not go away. There will be a small section where you can see what the SEBI chief is trying to do and trying to say. And we have already, kind of theoretically, we have or in this presentation, we've already understood why they are trying to say that. SEBI chief is going to say that in long term it will make money, so invest in long term, not in FNO, right? So I believe that you will be able to understand why she is saying that, and whether what she's saying has any base or it is completely baseless. So see you in future videos.
Margins from the clients themselves, and we have peak intraday margin as well. We think that the ecosystem is well protected. So from an ecosystem perspective, is the regulator anxious or worried about it? The answer is no.